Hi there, this is Helen Tarrant again from another here with our whole team. Wow, it's massive. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and I'm going to share with you today a little snippet of a webinar that I ran yesterday that had over 200 people attend, right? And it's a webinar about how interest rate rises, how that impacts on your cash flow in terms of a residential property versus a commercial property versus a regional property versus a metro property. So investing in commercial, but regional versus metro, and what that's going to yield you and the cash flow you're going to lose as the interest rate goes up to 6% and beyond. And then how you need to have a commercial property to support your residential property, and how if you have a residential property, if you don't do anything right now, you're literally watching your wealth be wiped off and topple over a cliff, right? How together you can actually be better positioned, because moving forward, it's really about survival of the fittest and having a strategy in place, having the right team around you, but most importantly, knowing why you need to invest into a particular type of commercial property has never been more important than right now. So this is what this snippet in the whiteboard from the webinar is about. So let's go to that. You can have a listen, and I'll see you on the other side. So a couple of things. Firstly, the reason you want to, if you are thinking of investing in commercial, to get in now, the reason you get in now, and preferably if you get in now at the right time, preferably you could have 2 rental increases before the interest rate goes too crazy, right? At the moment, I've budgeted one increase in rent, but if you could get in and say in the next, let's say 6 months, you have a rental increase, and then in the next 12 months after, you have another rental increase, that will actually buffer you, right? So let's just say that we had a rental increase, and then we had another rental increase. Let's just look at that. As a rental increase, and I'm using 4% as a flat rate because I think after what we're going to have, the high inflation is going up and down, we're going to find that 4% is going to be really where most people are going to end up happily sitting at. We probably will see some fluctuations between 2.5 to 3, and then eventually in the long term we're going to settle with 4. So some people will be on CPI, some people will be on 3%. So I've done just a general average of about 4%, right? So that goes up to, so you're negative about $500, right? So what I want to sort of firstly show you what happens is, if you hold residential property, this is your scenario here, right? So if you buy $1 million, so we're taking $1 million as an example, and we're taking it as 100% finance because you're drawing down on an equity, or that you've got, obviously if you have a deposit, you're going to get cash flow no matter how things change. You're going to be negative residential wise no matter what, but commercial you're going to have cash flow because there's going to be a return on your deposit. But I'm working on 100% borrowing from a deposit that has come from an equity drawdown. So we're using the 3% across the purchase price of the $3 million. So it's basically $30,000. So $30,000 is the interest only. If you're holding resi, after you add in your outgoings, and supposedly you're renting the property out for $600 per week, and we're talking about metro, you're getting $31,000. You've got your outgoings, which is your management fee, council, water, strata, and there's not any maintenance. You're down $13,200. If it's at 4%, you're down $23,000. 5% 33, 6% 43,000. So every time there's a 1% increase, there is a $10,000 out of pocket for you every time that happens. Pretty scary if you hold 5, 6 or 7 of them, right? Even if you hold 3, the difference between what you currently are and where it could be is 30,000. 30,000 times 3, all of a sudden you have to find $90,000, right? And that's pretty hefty for the average person who probably don't earn that much in a year's time to be able to afford that. And this way we have a self-perpetuating prophecy where people start to sell, and therefore then the value of the property dives as well. So what happens is this is what you are facing right now if you have residential, if you have $1 million in borrowings, right? Let's just say that, you know, that you've borrowed for $1 million property, you've got 2 properties, you've got $1 million. This is what you are facing. If you do nothing, this is your reality, is that is going to be how much you're going to be negative by in potentially 18 months. But what you also see is that the value of that property starts to go down, right? Because what typically happens when you have economy in crisis is that people no longer invest in a value asset because value in the asset diminishes. So value goes down. And what happens when value goes down is that your equity position goes down. Now, at the same time, you can't also service because right about when this happens, the bank also changes your serviceability. Where it used to be 1 to 9, they've reduced it already for a lot of banks 1 to 7, right? That is a drop. For most people, that straight drop could be anywhere from a 20% to 40%, depending on how much they earn, right, of borrowing power. So what happens is that straight off the top, you end up losing somewhere probably around that 20%, potentially more, to maybe even 40%, depending. Yeah.
Someone talking in the background, sorry.
Okay, keep going.
All right, I've just muted everybody. Does that help? There was a bunch of people who were telling me that we had a lot of background noise.
Oh, okay.
All right, is that sorted it? Okay, cool. All right, we've got a few questions coming up.
Yep.
Let Helen go through this, and we'll sort this in a minute, okay?
Yep.
We'll go through the questions. All right.
Magical television back.
Hey.
No one paid you the $20. This is what happened, right? So the value comes down, right? As the value comes down, then what you've done is you probably have supported this property, right? The whole idea of residential is that you support it for a number of years, and then at which point you sell out and you get the capital gains of that. But as you watch it go down, you have a choice. If you can't support it, you have to sell it, which means then you are selling something that potentially you've been accumulating for the last 5, 6, 7 years. And you could have sold at year 10 and got your full value, but now you're selling at a discount, not because you want to, but because it's forced on you by the economy, right? And purely because you can no longer service it. And that's one of the fundamental mistakes people make with residential, and that's how they end up losing most things, is because they never held it up long enough and circumstances change, right? Every time we have an economic downturn, every time we have a crisis, this is what happened. And so the worst thing you could do right now in your residential property is to actually take it and do nothing and watch it fall off a cliff. So you need to have cash flow strategies, and this is where things start to come in, and you need to start having cash flow strategies, right? And this is where you need to bring in a commercial property, or there will be other cash flow strategies you can invest in, right? There is, if you all of a sudden renovated your residential, add your granny flat, provided you have the capital, added the granny flat, did a subdivision, extension, whatever it is you make a cash flow, that's fine, right? Remember, this is not, as much as I believe in commercial property, how it can help you in your portfolio overall, this is not bashing residential. It's just more about you finding that cash flow strategy, to be proactive, right? So at the moment, we haven't got to 6 yet. But if you wait and you watch till we get to 6, it's too late. You've got to do this now so that you're protected when you get to 6, so you can hold on to your portfolio. So in the future, when you sell, you are not losing out. So that said, here we are. If you had $1 million in commercial property and you bought it now, I'm talking about now, so this is all now, right? Right now in Metro, it's 5.5% yield, $55,000 net, regional 6.5%, so 65,000, right? 3%, which is what we started out at the beginning of the year. We're not at 4% yet. Our latest loan that we've written is about 3.8% on a lease stock. So in Metro, you're clearing, and this is 100% borrowing again, similar. You're clearing 25,000, 35,000, 15,000, 25,000. You have a rental increase, right? It goes up, and when it goes to 5%, your 5K goes up to 7,200, and then your 15K goes to 17,600, right? Then when it gets to 6% is where, if you could add in another rental increase, like say you got one in the next 18 months, you're going to have 2 rental increases. This is where now the technique comes in. Like when you're now looking for a property, you need to look for a property that gives you 2 lots of rental increases in the next 18 months. That's something you need to do, right? Most people aren't aware of that, but when you look at leases, you look at things, you're going to start looking at that. These are some things that are going to be important, right? Because 2 rental increases at 4%, which for some people might be CPI this year, which we know it's already 4%, likely to hit, Sydney probably most likely higher than 4. But we've seen Brisbane at 6, we've seen Perth at 7, we're going to be more than that. So it's going to be more than that, and then it'll probably come down, but averaging over this 4, over the 18 months or 2-year period. Having those 2 actually means that even at 6%, you are going to be negative probably $10 a week, which I think for most people they can afford, right? You're going to be negative that, right? But if you're in regional, then you're not, even at 6%, you're not going to be negative, right? And if you had 2 rental increases, 6% is going to be negative. Only when you hit about 7% are you likely to be in that negative for your commercial. Now, the thing is, if you take the equity now out of your property, right, and you buy commercial, what you can do is what you realize is that this can actually help support this, right? So you can support the property, right? So for you, if you're looking for cash flow, you're not going to be able to buy Metro. This is not your scenario, right? This is your scenario. You're going to go for the highest yielding property you can find with security. So I'm not saying go to a mining town and buy 8, 9, 10% yield, right? You are buying 6.5 plus yield in a large regional area, and you're going to go say, and the whole thing is this is going to help you support that, right? If you can get a 7%, even better. That's going to help you support that. So you are less negative, right? And you can then, with the help of your commercial property, support your residential property portfolio, right? Because if you don't, what's going to happen is that you're going to be struggling there, whereas here, there's a chance for you to survive, right? If interest rates goes up to 10%, everyone is going to be negative, right? Everyone is going to be, it's going to be blood on the streets, and it's going to be a time where everybody will be struggling, right? And how much you struggle and how much you can hold on to the property and what you hold on to is now going to be the key and the fundamental of how wealthy you are on the other side. Because every time economic downturn happens, economic changes happen, what we find is those people who can afford to hold on or strategically place themselves to be able to hold on to a proportion of their portfolio is the winner on the other side. The other side, their wealth exponentiates, right? Because they've bought before, they've gone through the troughs, and the next time when the peak is always higher than the last peak, right? That is your pot of gold, right? But in order for you to sustain it, you have to be able to put in a strategy here to be able to have that cash flow support there, right? Even that, right? At 17,500, well, you have to find 17,500 is better than finding 33,000, right? Yes, rents can go up, and rents have gone up, but they're not going to go up to the pace of, they're not going to go from 600 to 1,000 or 1,200. They might go to 600, might go to 800, right? Which then will help with this, right? Which will bring this right down, and you might only be negative $5,000, right? And again, 7.5 goes in there, some rental increases. Again, there's more chances of you actually keeping your residential portfolio if you actually had a commercial property portfolio that's cash flow. That's cash flow driven, right? That is actually helping you. So that's the number one thing to remember. Number two is what happens with interest rates. So who remembers the GFC last time?
Yep. Anybody?
Anybody?
Oops, wrong button.
Got excited.
I do. That was a wild ride, and the one before that was even wilder. The one in 1989, 1990.
Oh yes.
Oh yeah.
Yeah. Yeah. So one of my first memories of being in Australia was actually the interest rate rises, right? I was 7, going 8, and I remember my uncle coming back home. He bought a house in Fairfield in Sydney's western suburb for $130,000 back then, right? Except the interest rate was 13% going upwards. And I remember that because I remember him coming home and going, oh my God, I'm not making enough money to sort of pay the mortgage, and and sort of just basically, I remember that time because it was one of my first childhood memories. And then of course I remember the GFC because I was trying to help my parents hold on to their residential portfolio, and every month it went up, right? And for me, the memory went up was that there was a 6-month period before things broke, right? Before we started having some rates going down. So what I actually think, looking back into history and what would happen, is that there is no other way for the government at the moment to actually correct inflation, right? They don't know any other way to correct inflation. And so what will happen is that they don't know what the ceiling is in the interest rate market, because they don't know how much savings and how much people can really support, right? To a point where we pretty much have people on a fire sale, right? So what we will see is that they will put the interest rate up, right? They will continuously put the interest rate up till basically the camel breaks, till the market breaks, and we're going to see people unable to hold on, right? They're going to go, oh, that's our ceiling, and that could be 6%, could be 7%, could be 8%, right? And for most of us to get to that same 17% mark that we were experiencing during the 1990s, the late 1990s, it's actually
17% was 1989, 1990.
1990,
Oops,
yep.
Sorry, I did accidentally mute myself, sorry. 1989, 1990.
Okay, so 1989 to 1990 is 17%. Now today, at 7 to 8%, that is the same equivalent, because we are borrowed more than what we did. Imagine 1989, my uncle borrowed, he borrowed less than 100 grand, probably about 100 grand for a property in Fairfield, right? Someone today is buying that same property, probably renovated and done up, for probably close to $2 million, right? Or maybe 1.5, to 2 mil. So, that property have gone 10 times, right, in that time, right?
Ooh, 10x.
Yeah, right. So, but the thing is, people are highly leveraged, right? So they're not borrowing 100 grand. They're borrowing $1 million. Sometimes it's very common for the average couple starting out to borrow 1.3, 1.4, 1.5 million to buy their home, right? And and so we're going to see interest rates go up, and some people are predicting that we're going to come straight down again. It's not going to come straight down again. What will happen is that we'll go up, the world will collapse, it'll come down a little bit, just to see how well everyone is holding. And then it will plateau a little bit, it'll come down a little bit, it'll plateau a little bit, it'll come down, and then it will hold, right? It will hold just so that you can make your mortgage repayments, you can pay your bills, you can pretty much make things work, but you don't have the same disposable income you have now, right? Unless you found a way to make 20% more or 30% more than what you're currently earning, right? You'll hold out to then before we actually start going down and going to a more acceptable interest rate, at which point we'll peak, and the next thing we'll see is interest rate will come down, and then it'll go through the cycle. But this here to here, that is the true test of how long you can, that is the true test of protecting your wealth. Right? Exactly. This gap here.
Sorry, I'm laughing because someone suggested that when the tide goes out, we'll see who was swimming naked.
Yeah. Yes. So this gap here, right? This gap, or this period, or we call it this period, this hold period, is the key to your wealth, right? And whether you do something now, today, is going to determine how well you last out of here, right? Fortune do favor the bold, and you can take calculated risk right now, but if you don't have a strategy now here, you're going to go down, right? This is what will happen, right? There's going to be people that are going to go down and literally lose their savings, their whole life, they're going to lose their family homes. This is what's going to happen, right? We've seen today the latest reports that financial year closed, the market of self-superannuation for the 5th time in the history of the last 30 years are down again. So people have not had a great ride, and they tell me, why should I invest in self-managed super fund? Well, the newspaper basically said, you know, it's gone down 5 times in the term of 30 years. Now, how long is that period? No one exactly knows, right? It can be 6 months, it can be 12 months, right? But somewhere between this rise and this rise is going to be pretty fast. We're going to be on a pretty fast trajectory, as seen by the States and I'm sure a few other countries, that it's going to go up. This gradual come down, how long that lasts, is probably not going to be a 3-month period. It's probably somewhere between anywhere from 6 months to 12 months. It's most likely going to be, so this hold, up and hold, is where you have to be proactive to protect what it is, right? And this is where essentially we come back to why we talk about today, the yield gap, right? The yield gap is really what you're getting from the bank and what you're getting from your tenants, right? That is your yield gap, right? Call it yield gap or margin. And effectively is what the bank makes money on you, right? They get the money at 1%, they lend it out to you at 4%, right? And they make that margin, right? So right now, this is the period where you have to make a decision, a conscious decision right now, how you're going to protect yourself. And the cash flow is key, right? Gear up for cash flow. So what I have a few suggestions around. Firstly, potentially, if you have any underperforming assets right now, make sure you cut your losses and sell them, or refinance them, put a new tenant. Make sure you spend the time, as we're going up the trajectory, really tidy up your underperforming assets. Because if those assets are underperforming now, they will be even worse in the future, right? In the next 2 years, right? So if at the moment you're not getting 600 market rent and you're able to get 400 or 500, then this picture looks worse, right? So you want to make sure you get your property ready for the hold in the future, right? So you've got to make sure your worst performing asset, you either sell or turn them into their best performing assets, or an asset that is going to generate stability and income, right? If you don't have cash flow, go and find a cash flow strategy. Renovate, granny flat, do any of those things for resi. Buy commercial property if you have equity and you can leverage equity. If you have a redraw facility, redraw it, buy commercial, build the cash flow so that it's self-supporting, right? Even if you buy commercial and you sell it in 2 years' time, right? At least in this period, it's helped you hold on to your residential property, right? So you've got to be prepared. You've got to at this time really find that balance, right? And you can't afford for underperforming assets, right? You got to get loose that baggage so you can be leaner and faster and be able to pivot faster if the market changes anymore, right? So you've got to make those swift decisions. So for example, if you have 3 or 4 residential properties and you get to a point where you know that at 6% you cannot hold, you already make that decision now what you need to sell at that time. As it looks like it's going to go there, that property needs to go on that market. Do not try to rescue everything, because if you try to rescue everything, you end up losing everything. The best thing is, how do you balance, right? Find that strategy now, get into the market. Don't quibble that you're going to get 6.5%, right? Because when you quibble, someone else is going to go there and get 6.5%, and someone's going to end up with 6, right? And the reason for that is those who are savvy investors know this already. They know this already. They know that if they don't get in, they don't have a chance on the other side, right? So for them, 6.3% is better than 6%. 6.5% is better than 6.3%. And so if you're not willing to pay 6.5%, if you think that's too low, then the thing is someone else will get that 6%. The other thing is, be realistic, right? Some people now say, oh, well, I can get 5.5% in Metro before. Now the interest rate's gone up, I want 6%. Well, then you can just sit back and watch it topple off a cliff, because you're not going to get 6%. Because it's not until probably here that some of this 5.5% yield might get to 6 or 5.75. At here, it might go to 6%. But the problem is the demand. See, commercial property operates on supply and demand. There's more demand now than there's supply. So what happens is that the yield is going to hold tight or even fall, because there's more people buying, because they're all trying to do exactly this. And you got to get ahead. You got to get in front of everyone. And really, You just got to be prepared. Well, I hope that's been informative. Look, there's a lot of information there, but the truth of what happens is right now, if you decide to hold for capital growth, you've got to make sure you've got cash flow. If you decide that you want cash flow and that you need something to sustain your portfolio through the next couple of years as interest rate rises and we're in a volatile market, you need to think about investing in regional. Sometimes you might not want to. Sometimes you might feel like I'm going to chase growth because that's what I've always done in the residential space. Sometimes you think that it will be more security in growth, and sometimes you think there's more risk in regional. Absolutely, those things are all correct, but properties are independent of each other when it comes to commercial property. Your tenant, you need to assess them on an individual basis. So really moving forward, if you really want to look at a concrete strategy to how you should position yourself in the next 2 years so that you don't lose your wealth, so that you can keep growing, because I can guarantee you, if you do it right and you do it now in the next 3 to 6 months, you will be well positioned for the volatility ahead. And what that will mean is you come out better, richer, wealthier, more cash flow at the other end. But it's about now survival of the fittest, right? And you have to be in that position where you have the right strategy and the right cash flow and the right type of property so that you can become the fittest, right? And the strongest in this upcoming market. So if you're looking for someone to help you build that portfolio, help you to become stronger with your strategy, help you there by surrounding you with a team and a community, reach out to us, Unicorn Commercial Property, Helen Tarrant, helen@commercialpropertycashflow.com.au, and let's jump on a strategy call. Let's have a chat about how we can help you and partner up with you, how we can work together through education, through buyer's agency, or potentially group deals to help you go the next level in commercial property, but also protect your current asset as well. So in the meantime, till the next video, hit the bell, subscribe, and I'll see you in the next video with some new topics on how to maintain your cash flow through this upcoming volatility in the market. Bye for now.